Potential red flags. This gets fun. They told the SEC their accounting is broken, like all of it. Internal controls have 5 tests, and most companies, they might cop to 1 material weakness, maybe 2 if it's a super rough year. In their own F1, we identified material weaknesses in our internal controls over financial reporting related to all 5 components of the COSO framework. So 5 for 5, high score. Does that mean I broke it? Number 2, whole C-suite still looking for the bathroom. They got here about 10 minutes ago. The CEO is new. CFO started in July of 25. Chief Legal Officer, June of 25. Chief Accounting Officer, October 25. Chief People Officer, January of 26. So every executive whose name in this document has been in the chair for a year or less. And by the way, they have material weaknesses and they're going public at 8x leverage. So do with that what you will. Number 3, they were lending money to their own parent company at Sonia plus 6.55%. So tucked into the related party footnote, $127 million of interest income in FY25 from loans Cumberland Farms made to its own parent. Sonia is not my ex-girlfriend. It is the Sterling Overnight Index average. That is 18% of adjusted EBITDA earned by lending money upstairs to the guy who controls the company. The balance was $5.6 billion in December and $1.9 billion by March 31. So roughly $3.7 billion moved, I don't know, somewhere in one quarter. Where did it go? Nobody knows, but they claim it all gets settled before the IPO closes. Cool. Number 4, Big Tobacco is funding the loyalty program. So their P plus tier, weird name, 122,000 members, is paid for by Altria. Loyalty members buy 49% more tobacco than everyone else. Tobacco is roughly 10% of revenue. Also, did you know it's addictive? Number 5, foreign private issuer controlled company Cayman Charter. That's a trifecta. Like I said, no 10Qs, no 8Ks, no Reg FD. They get to file late. So if you want to sue them, pack a bag. You're going to the Caymans. Number 6, one supplier is 31% of their entire cost base. The largest fuel supplier is 31% of total cost, and they've committed to buying 6.5 million gallons under minimum volume controls. Those commitments are exactly why they get that good rack price. It's also why if gallons keep sliding and gallons have slid 3 years running, they're contractually obligated to keep buying gasoline. They may have to sell at a discount. Number 7, the balance sheet is stale AF. Financials run through March of 26. Since then, they took over $1 billion of additional debt out. Neither one is in that debt figure that we already quoted. Who's in the cap table? So EG Group is the roll-up entity. It's actually what this was called up until a few weeks ago when they rebranded to Cumberland Farms. And 2 parties built EG and will keep control after the IPO. The first is TDR Capital. It's a London private equity firm with about $16 billion under management, which also owns a large European supermarket called Asda. The second is the Issa brothers, Mohsin and Zuber, who started this whole thing. They bought that single gas station in Bury, England in 2001 and just never stopped buying stuff. TDR merged its own gas station business with theirs in 2016, and the combined thing became EG Group, which became Cumberland Farms. Then they went shopping. About 760 convenience sites from Kroger, 570 Cumberland Farm stores, 540 Woolworths sites in Australia, which they sold, over 2,000 Esso sites across Italy and Germany. But then they go selling. Since 2023, they've been selling it all back. The UK for more than $3 billion, Italy for $450 million, Australia sold for $830 million. They buy the world on debt and then sell half the world to pay the interest. What's left is what you're buying now. So America, Germany, Benelux, a parent entity still named EG Group Limited sits above you and keeps all the votes. What do the comps look like? Well, nobody good is public. The comp set here is thin, if I'm being honest. Wawa is private, Sheetz is private, so are Quick Trip, Buc-ee's, and a racetrack. They're all family-owned or employee-owned, so when you go looking for a comparable company, the 4 you're left with are Casey's, Couche-Tard, which is Circle K, Murphy USA, the kiosk in the Walmart parking lot, and a levered roll-up called Arco that nobody talks about because it's no bueno. Valuation, they're asking for roughly $9 billion of equity on a $1 billion raise. If you tack on the $5.8 billion of net debt, you're paying $14.8 billion of enterprise value for $693 million of adjusted EBITDA, which is 21x. So Cumberland Farms wants the Casey's multiple, but they have Arco's balance sheet, which is a problem here. And Arco's trades at 11.5x, right? Not great. Casey's is the business that bankers want on the page, and I get why. It's trading at 24x against a 10-year median of 11.5x because it grew EBITDA 24% last year, and its prepared food operations runs like a well-oiled QSR. Then there's Arco, which I'd argue is the closer read on what Cumberland Farms actually is, which is unfortunate for Cumberland Farms because Arco is a roll-up of regional convenience brands that nobody outside of a 3-mile radius has heard of, including myself. It's levered at about 8x, just like Cumberland Farms. It's also lost money last quarter, and it's busy converting company-operated stores to dealer-operated stores, which is the exact Coco to Conco move going down in this filing. Oh, and it franchises fried chicken, and it leans on the loyalty program. And in February, it took a subsidiary public and used $207 million of the proceeds to pay down debt, which is also what you're being asked to fund here. So Arco trades at 11.5x EBITDA. The entire company is worth less than $1 billion. So tough comp. They're basically asking you, like, hey, can we have another $6.8 billion on top of what the market pays for a company that looks a lot like this one? So perhaps the gap is made up of childhood nostalgia, slushies, and scratch tickets. Miscellaneous stuff of note. B of A is lead left, not Goldman. So the cover reads B of A Securities, then Goldman, then Jefferies. Goldman has been lead left on basically everything this year. And getting bumped to the 2-hole on a $9 billion deal is not nothing. It usually means someone's relationship banker has been camped out in Charlotte for 2 years. Massachusetts was the last state in the country to allow the little clip on the gas pump, okay? I had to put this in there. So you know what I'm talking about. You squeeze the handle and you flip the metal tab up and you can walk away and go inside. Nah. So every other state had them. Massachusetts banned them from 1970s until January 1st of 2015 on the theory that you'd get back in your car, build up static on the seat, I don't know, grab the nozzle and light yourself on fire. So for 40 years, everyone I knew jammed their gas cap into the handle instead. If you know, you know. The reason it belongs in this filing is that one of the arguments against the clips was that a customer stuck holding the nozzle does not wander inside and buy a soda. So the clip is an inside sales tool, and inside sales run at 31% margin, which is like the gas only runs at 10, right? So we got to fix that. The rollout took years anyway because nobody wanted to pay for the new nozzles. They employ 32,252 people and never mention health insurance. So the employee benefits section of this filing covers pensions, Jubilee awards for long service, bridge pensions, and voluntary redundancy packages. But all of that is for the European people, right? There's not one word about health coverage for the 16,597 people working in America. So it's a foreign private issuer and they don't have to actually file human capital disclosures, so they didn't. What they do say is they keep a flexible workforce of hourly, part-time, and temporary workers so they can adjust staffing on short notice, and that the employee handbook has an anti-bullying policy. That's really cool. Robert Swan, the former CEO of Intel, is on the board of a gas station, which is a hell of a third act. Summer is the good quarter. I always like to talk about seasonality. So demand for fuel, snacks, and food all run higher in summer than winter because people drive more. Worth remembering when the first few quarterly prints come out and everybody acts surprised. This is funny, but the charts in this F1 filing look like someone's Excel model because they are. So rather than hiring a graphic designer, they just took screenshots. None of this is investment advice. I wrote this from my home office, hyped up on stale AF Cumberland Farms coffee. I wish you an IPO with ample float and a working hold open clip at your gas station. Peace. Everyone in finance is adopting AI right now. There's a problem because there are a dozen disconnected tools. You got one for revenue, one for AP, one for close, and each one of these needs training and documentation. And the expertise to run them lives in your team's heads, not your systems. Maximore takes the opposite approach. One autonomous finance platform for the whole operation. Order to cash, procure to pay, the close, cash management, reporting, running on a single unified finance context that pulls from your ERP, billing, banks, even email and Slack. Maximore runs on self-learning agents that learn how your team already works. No prompts to write, no workflows to build, nothing to document. Every output is audit ready, and when a call needs human judgment, it escalates for review. Because the agents optimize, not just execute. And your KPIs improve. I'm talking about DSO, working capital, cash conversion. In fact, one PE-backed customer cut their close in half. Their audit findings from 7 to 0, back office costs down 70%. And in 6 months, no ERP rip and replace. You pay only for real outcomes, not seats. See it at maximore.ai. That is maximor.ai.